Welcome to the second session of this morning's conference. Those of us who work on the problems of the international financial system are accustomed to toiling in obscurity, and so we're very grateful to the organizers of this conference to devoting some time to these backwater issues on which we with which we've been concerned. I'm James Galbraith, professor at the LBJ School of Public Affairs here at the University of Texas at Austin, and our panelists today are Jan Kregel, who is a professor at the University of Missouri at Kansas City and senior scholar of the Levy Economics Institute, John Hicklin, who is the Deputy Director of the Office of Independent Evaluation at the International Monetary Fund. And so I'd like to begin by asking each of you to take perhaps 5 minutes to say very briefly why what the importance of the international monetary situation with which we're facing, international financial crisis that we're facing is, and how you see that crisis having developed and developing over recent months. Jan, you want to take it?
Okay, let's start with the impact of the crisis on the international financial system, on what we usually call international financial architecture. Up until the outbreak of the crisis, we had been following a model basically in which we were trying to suggest to developing countries that the appropriate forms of regulation for their financial systems should mirror those that were being developed in particularly the United States and Europe. And this was primarily a model in which we believed that market participants were the best regulators of their activities, called the ability of markets to self-regulate, or what we often call counterparty regulation. And these were set out in a series of best practice standards and codes, which were produced by the Basel Committee on Banking Supervision and basically implemented by the International Monetary Fund in a series of measures and a series of institutions in which they set up in order to assess developing country financial systems. Now, we learned from the crisis, or as Alan Greenspan learned from the crisis to his great shock, that in fact financial institutions are not very good at self-regulation, and counterparty regulation in fact does not lead to stability. So the fact that this crisis started out as a regulatory crisis in developed country financial markets calls into doubt the entire project which we have been using in order to try and generate a regulatory environment in the international sphere, and in particular for developing countries. So I would say the basic contribution that the crisis has made is that it tells us that we have to rethink the way we are looking at not only national financial regulation, but the way we're using particular national financial regulations in order to make recommendations to developing countries. It's extremely interesting that a large number of developing countries, in fact, have had a much smaller impact, or have received a much smaller impact in terms of their financial systems than many developed countries. Take a system like Brazil. Brazil obviously has been impacted by the crisis, but if you look at the Brazilian financial system, the major financial institutions in Brazil are still in much better conditions than financial institutions, for example, in Europe, in Eastern Europe, or in the United States. So this tells us that perhaps we have to be a little bit more circumspect in simply extending the kinds of regulations we believe to have been appropriate in the developed country systems to developing countries. Second point going on, where the crisis is likely to move. Obviously, Every time we have a financial crisis, everybody says that we have to reform the international financial architecture. Remember, after the Russian and then the long-term capital management crisis, in the summer of 1998, we had the President of the United States affirming that we have to reform the international financial architecture. Well, in the space of about 6 months, the system more or less went back to the way it was before, and the idea that we had to reform went back to the bottom of the priorities of the administration. This time around, the problem is not going to go away. That is, we are going to be in conditions similar to the ones that we're looking at, probably for the next 2 to 3 years, if not much longer. So the question of international financial reform will stay on the agenda, and we're going to have to do something about it. Now, in this particular respect, very quickly, if we look at international financial architecture, we sort of have 2 basic models. First basic model was the one that came out of the interwar period, in particular the Roosevelt administration, and the position of Henry Morgenthau, which said that what we want is an international financial system in which we drive the private money lenders out of the temple of international finance. And the idea was that government agencies or intragovernmental agencies, multilateral institutions, should be responsible for intermediating private financial flows. Now, this was supposed to be set out in the Bretton Woods agreements. In the end, it was only really a half-baked attempt to do this because private institutions remained central in intermediating capital flows. As we went through the liberalization and deregulation of markets in the 1970s and the 1980s, and eventually the reforms that were done to the IMF, the International Monetary Fund, we returned to a system basically, as I mentioned, in which we believed that not only private financial institutions should intermediate those flows, but that they should also be the regulators of those flows. The result of that we saw in an increasing number of financial crises, starting with the Mexican crisis in the 1980s, second Mexican crisis in the 1990s, the Asian financial crisis, the Brazilian exchange rate crisis, and so on and so forth. So if there is going to be some sort of reform of the international financial system, it has to be to go back and look at the way we intermediate international financial flows. And it is more than likely that there will be some sorts of controls set on the ability of private financial institutions and international financial speculators to move funds back and forth across markets simply for the quote-unquote efficiency of the market rather than for the ability to use those flows in order to finance productive investment and growth in developing countries.
So just to summarize very quickly, I see a first point which raises a very profound question about the philosophy of regulation that has come to dominate discussion of international financial markets, particularly in the major developed countries. And second, flowing from that, a very deep question about the architecture and in particular the role of private financial institutions in international capital flows, the 2 essential points. And I wonder if I could now turn over to Mr. Hicklin and get both your reaction and your own perspective on those issues.
Well, thank you very much. And I think this is a very useful kind of forum in which to discuss these issues, partly because I think it's important that we do think, perhaps by the end of this discussion, how it is that universities, academia, link up with policymakers in trying to think through these issues. I think it's a very useful exercise. Well, first you asked about the importance of this crisis. It's clearly very important. It is going to affect not just millions of people in the United States, but billions of people throughout the world. And although there is talk so far about the effects in the US and the advanced economies, to some extent emerging market economies now have been affected in some parts of the world, but we've also some of the great advances that have taken place in Africa over the last decade and so on are going to be more vulnerable as these events develop. So it's clearly very important, and we should not underestimate. So what I'm going to sort of talk about a little bit more appears at one level to be very arcane. It talks about strengthening institutional frameworks. But they're not an academic exercise. I mean, they do, at the end of the day, have real consequences for many people, and that's the sort of one point I would make. If you look at the debate as it's developing now, I mean, and from what has just been said, there seem to be three different aspects of it that I would point to. One is that what are the substantive issues? Here, the mention of regulation. Is there a better way of doing regulation of private financial institutions in a much more complicated, interrelated world? That's one of the issues. There are many others. That's on the substance of the economic regulatory policies. The second sort of basic issue is, well, who is going to do these things? What is the architecture as it was described in the previous set of reforms? Who is going to conduct this either regulation, or who's going to be in charge of seeing that these various aspects of the system are working or not, both at a national level and an international level? There's a tremendous amount of debate on that at the moment. And the third element, which I perhaps can speak better to, because I've been working on it more closely, is how, once you've defined those things, you make any of the individual bits of it happen. How do you make various components of the system more effective than they have been? And from my own perspective, looking at the evaluation of the International Monetary Fund, we have just last year put up a fairly major report on the governance of the IMF and how it might be strengthened and improved. It's out in the public domain. There is a very large discussion now from many sources in the International Monetary and Financial Committee of the IMF, the various groups of governments, the G20 and the leaders of the G20 at the moment, in the UN and so forth, about how these reforms take place. But at least we were able to put forward certain propositions about how, from our perspective, the fund's own governance ought to be strengthened in order for it to tackle some of these issues that have arisen more effectively in future. I can give some specific examples of where we see there have been a lag in effectiveness between ideas that were clearly identified in earlier years and the extent to which they've been incorporated into the effectiveness of the institution in the recent crisis.
Thanks very much. One of the things that troubles me a little bit about the way in which conversations on this topic sometimes move is that we may move a little too quickly from the declaration there is a crisis to a discussion of the appropriate regulatory framework for the period after the crisis is over. And it seems to me that it would be helpful to have, to put this into perspective and to bring it into the immediate present, to have your views of the sources of the crisis and of the steps that will be required to manage the crisis itself, as opposed to the system once, whatever it may be, once the crisis has passed. If it is a crisis, it will by itself and in important ways change the structure of the system. So I'm wondering if I could ask each of you to say a few words about the origins of the crisis in the two important regions which seem to have related but at least somewhat separable major problems: the United States and Europe, particularly the Eurozone, but the relationship between the Eurozone and Eastern Europe and associated developments. Go ahead.
Okay. Financial institutions are businesses like any other business, and they have to generate rates of return that remunerate their shareholders. On the other hand, financial institutions, and particularly banks, have always been treated as having very large externalities that impinge on the public welfare. Therefore, we regulate them. Now, any industry that is regulated and has to live under those regulations automatically has its returns reduced. So that you have to look at ways in which to provide that regulation which allows the institution to continue, if you like, to compete in private capital markets to remunerate its investors. If we look at the beginning of the U.S. Glass-Steagall system, we had set up a series of regulations on what we would call market variables, which in a certain sense guaranteed a rate of return to financial institutions which allowed them to exist. For example, we had Regulation Q, which set the deposit rate that banks could pay at 0. Now, this meant providing basically free funding for banks. Okay? This was a way in which a regulation provided a benefit, if you like, a cost and a benefit, which allowed financial institutions to exist. Now, as the U.S. system tended to evolve and we got into a more liberalized, deregulated, and competitive system, many of these regulations, which were looked upon as decreasing the efficiency of the market, were eliminated. But as we sought to increase the efficiency of the market, at the same time we increased competition and brought about a very sharp reduction in the returns to bank capital. Now, as a result of this, you saw quite naturally that banks reduced substantially the amount of capital which they held in order to fund their operations. And in this sense, we can say that this process may have made the system more efficient, but it also made it more risky. Secondly, an alternative way in which the banks tried to increase their returns was by moving away from what we call the standard business of banking, that is, the taking of deposits and the making of loans and generating profits by the difference between what you pay to borrow funds and what you charge to lend funds, towards what we call fee and commission business. Fee and commission business comes from the ability not to make a spread on your borrowing and lending rates, but simply from charging for financial services. Now, under Glass-Steagall, commercial banks were limited in terms of the range of these financial services that they could offer. So the part of the liberalization process was to allow commercial banks to encroach more and more into what had been the domain of investment banks to generate this sort of fee and commission business. Now, basically, the fee and commission business is capital market business and is also much more risky than the basic type of lending business that banks did. So again, an attempt to reach for yield on the part of banks increased the riskiness of the operations. Now, we saw the limit to this recently in the extension of securitization. Securitization does what? Well, basically, securitization says that a bank can generate fee and commission business by originating an asset, but it no longer has to hold the asset on its balance sheet, and therefore it doesn't have to hold capital on its balance sheet. So on the one hand, it saves on the capital side. On the other side, it increases the amount of fee and commission income that it gets. So that you had built in to the system the pursuit of a normal rate of return for banks, an impulse towards increasingly fragile activities, increasingly risky activities, and also a push towards what eventually people discovered as the so-called originate and distribute model. Now, when we get to subprime, subprime was what? Well, subprime in particular was not important to banks other than the fact that it was another market in which they could originate something for which they could charge fees and commissions, and it had absolutely no capital charge, and they didn't have to hold it on their balance sheets. So if you like, it was sort of the reach or the attempt of financial institutions competing with one another to earn an adequate rate of return that led into increasing risky products and increasingly risky balance sheets. Now, if we add on to that the introduction in the end of the 1980s of the Basel Banking Commission requirements that banks had to increase their capital holdings against their loans on their balance sheets, this simply gave an additional impetus, that is, if you like, another impulse to the banks to engage in the sort of activities in which basically they simply stopped doing what banks were traditionally supposed to do, and that is assessing the creditworthiness of their borrowers. Because if the banks no longer held the loans on their balance sheets, they really didn't care if the borrower could repay or not. The only thing they were worried about is originating the loan, getting the fees and commissions, and then selling it off into the capital market. So effectively, what you had was a system which felt that it could distribute risk across the system, but it no longer was evaluating risk. And if we had a failure in the system, the failure in the system came from the fact that no one was interested any longer. It was no longer profitable for banks to evaluate the risk of the loans that they were making. So we ended up with this very sophisticated system for pricing risk and distributing risk, but nobody, in fact, was interested in evaluating that particular risk. So this is, I think, where we got into difficulty. Now, the question is what we do to resolve that problem. Regulation, as you say, on a long-term basis is more or less independent of the measures that we take on the short term. Now, the measures that we've taken in the short term basically have been to allow the agglomeration of weaker banks with stronger banks, or weaker banks with what we thought were stronger banks. Because when we allowed Bank of America to, well, when Bank of America was encouraged to buy Merrill Lynch, the presumption was that Bank of America was sufficiently strong in terms of its capitalization to absorb Merrill Lynch. Well, we discovered after that that in fact Bank of America wasn't in that great a shape, and Merrill Lynch was in shape that was much worse shape than we had anticipated. Now, there are two aspects to this. The first is that you create a very large financial institution, which is just as weak as the two smaller institutions that you had before. And this means that any attempt to regulate these institutions becomes that much more difficult. Because one of the pushes towards self-regulation was the belief that federal regulators could not, in fact, adequately monitor the activity of these banks. So if the banks were already too big to regulate, what we've now done is to create a system of banks that are much too big to regulate. So the problem of regulatory reform becomes that much more difficult by pursuing activities in this particular way. The second thing deals with the losses that were incurred by Merrill Lynch. The losses that were incurred by Merrill Lynch were not losses that related to repricing of the securities on their balance sheet. The losses that Merrill Lynch had in the fourth quarter of last year came from Merrill's ongoing trading activities. That is, Merrill was trying to trade itself out of a hole. Just as in the savings and loan crisis in the end of the 1980s, we thought that savings and loan banks could grow their way out of the crisis by generating sufficient revenues in order to offset the losses.
Gambling for resurrection.
And what happened to Merrill is what they thought was a very, very safe trade. Effectively, what they were doing was buying bonds and then insuring them with credit default swaps, discovered that there was substantial basis risk, which they had not taken into account. The basis went the wrong way, and they ended up making tremendous losses on what they thought were very safe and secure speculative activities. So the second part is that despite the fact that we've tried to resolve the crisis by making the banks sufficiently large so that we create banks that are safe, they are still engaging in activities which are reducing their degree of soundness and their degree of safety.
I wonder if I could ask John to come in on and talk a little bit about what is happening in Europe, in the European banking system, where there are also, as I said, difficulties of a related nature.
Yeah, I'm not privy to very much of what is happening other than what we all read in the newspapers and so on, but there clearly are I would make a couple of points. I think there are clearly big differences between the US and the European systems in the way they operate. But I would also point to the fact that the trade-off between the risk which institutions make in doing their activity and the ability of the system to regulate itself has been looked at in different ways. I mean, there was specifically, for example, a process set up to ask the question, is the financial system sound in both European major economies and in the United States? This was a deliberate attempt to learn lessons from previous instability in financial systems. The fact of the matter is that after a few years, this evaluation assessment was conducted for several major European financial systems. But has not taken place in the United States. There was a voluntary loophole in the United States' willingness to undertake an assessment of the stability of the system as a whole, so that the questions that could be asked of whether or not the balance between individual private institutions taking risk and the ability of the supervisory system to understand those risks and to do something about them. Those questions were never asked in the way that they were done, even in the European context, in major economies. Now, that's not to say that those questions are either easy to delve into, then the answers are certainly not easy to come up with, nor is it to say that having that assessment itself would have produced a much safer system and we'd all have been in much better shape now. But it was at least one step set up in the early 2000s in order to see and ask the right question of the people involved. It happened a little bit more in Europe than here. It didn't happen at all here.
But one focus of such efforts, it seems to me, is to ask the question, is the bank doing the right thing? Does the bank have appropriate controls? Is it behaving in a prudent way? And an approach of that kind, which certainly has its value and importance, may miss an essential feature at the origin of the systemic problem, which in the European case may well be, on the one hand, the volatility of exchange rates across the European region, and including from Eastern Europe to Western Europe, and on the other, the limitations to both the ability and the willingness of European institutions to act as a whole to govern, for example, the exchange rate risks that banks may take when they lend to Eastern Europe for finance mortgages in Hungary in instruments that are indexed to euro or Swiss franc or to the dollar. And we've come to a situation in which late last fall, it became necessary in order to prevent an unraveling, in effect, of the carry trade that originated in New York for the Europeans and others to arrange for about $600 billion of swap agreements with the Federal Reserve, in effect, to prevent a mass sell-off of non-U.S. currencies in order to find dollars to refinance liabilities that were due in New York. And I'm wondering how you see, I mean, this is an issue of international financial structure and therefore very much in the territory of the International Monetary Fund. And I'm wondering whether you see that as potentially a crisis of the system, or is it something which is not yet something on which we should be justifiably focusing or worrying, is something that's going to blow over in a few months, and those swaps will be unwound and repaid when they come due in April or October.
Yeah. I'm not privy to exactly all the details of it, and not on the operational side of the fund that would be privy to what's happening behind the scenes in many of these countries. What I would say is that to ask those questions of whether or not the balance sheets of the different institutions and whether or not the supervisory systems in each country and the region as a whole are actually doing the right job. The question I would ask is whether that questioning has been done sufficiently. So it's at a higher level of discussion of, rather than the individual problems in either a region or individual country, looking at, well, was the system set up for those very difficult issues to be investigated and to be acted upon at the time? And it's very clear that the issue was raised 2 or 3 years ago, that more needed to be done about assessing the cross-border implications of modern banking activity in Europe, for example, and to make sure that everyone is brought to the table from the different parts of the financial system and the governments and so on, so that they had a handle on these issues and could assess the extent to which these are within a risk that could be looked at in stress tests and so on, to see whether the system was stable enough to take those, or whether it posed a systemic risk which needed to be dealt with. And I think that's where there has been a lag in the ability of national governments to undertake the questioning that would enable you to answer those questions. I mean, now they're being asked again, as if it's somehow new that it's a major challenge to incorporate the combination of macroeconomic and financial analysis. Well, this is not a new issue. It's been raised for many years. The question is, has it actually been done? Have the analysis of spillovers between one country or one economy and another really been analysed in a way that can help people determine what's happened? These are not new issues as in a broad sense. The question is, why were the systems not fully active in asking the right questions at the right time, to bringing that back to a policy debate that would have then maybe mitigated? One can never know exactly what the counterfactual is. But at least if those steps weren't taken, then you know that that was something that could have been done that was not.
Do you have a thought on that?
Yeah, I mean, part of the difficulty is that there's a certain ambiguity in the way we look at systemic risk in financial regulation. Now, traditional financial regulation looks at systemic risk as a problem of an individual, trying to prevent problems in an individual bank. If you look at, for example, at the BIS regulations, those regulations are all centered on what an individual bank's soundness and security involves. So that what you're trying to do is basically to avoid the rotten apple in the barrel contaminating all the rest of them. And we've talked about this in terms of FDIC insurance. The insurance is there so that you don't get a bank run on one bank that spreads to the entire banking system. So it's very much, it goes from the individual to contaminating others. Now, if we look at the way traditional systemic risk in the financial system was interpreted, this is what Mariner Eccles noticed during the Depression, when he lobbied in favor of reform of the Emergency Banking Act, eventually the 1935 Act. And his argument was, Eccles, who became the chairman of the board under Roosevelt, was a Utah banker. And he said, look, during the Depression, all of the banks in Utah, all of the banks in California were sound. We had absolutely good practices. All of our loans were good. All of our borrowers could meet their payments. And then all of a sudden, Wall Street collapsed, the economy collapsed, and all of my good borrowers started to default. Okay? Now that's what he interpreted as a systemic risk. Systemic risk is not something that comes from the activity of an individual. It's something that comes from the operation of the entire system and then has an impact on each individual. And as I say, we have a certain amount of ambiguity. Our regulation so far has always tended to be looking at, well, if we manage to make the individual safe, then we're going to make the system safe. But we're now in a condition where, in fact, that is not the case. It's not the case in the Depression. And this is what we've lost sight of in terms of what we would call systemic regulation. I think this is the point that you were trying to raise. Do we have an institution that takes care of that?
Could you say a word specifically as to whether that counts as an effective critique of the Basel II accounting and other conventions?
Yeah, I would say absolutely. I mean, we have now seen that Basel II, even if it were to have been formulated in the most correct possible manner, would not have been sufficient to offset what we have seen in financial markets today.
John, do you have a view on
Well,
that?
I would come back a little bit on this issue about the responsibility for financial stability. I mean, many governments have, either the central banks or the agency responsible for financial stability, have gone about various techniques in recent years to check the stability of the system. The question is whether those systems have been effective enough in dealing with what are major shocks to the system. How are those systems checked and evaluated? And that's, I think, where there's a question which obviously we'll have to look at. The point I was making in the context of the perspective the IMF brought to the United States, for example, was that there was a system at least established under the so-called FSAP, the Financial Stability Assessment Program, to at least go in each country on a voluntary basis to ask the questions by bringing together the experts and see whether or not there were issues that needed to be explored further. That was simply not done in the US. Had it happened, would it have solved all the problems? I doubt it very much, but it would at least have begun a dialogue and a set of discussions which would have helped. And although the US has now agreed that it would undertake one, it's rather sort of late in the day given the build-up of risks which have been taking place over a period of time. So I'm saying that This concept.
I have the impression, I read a little bit about the proposal for an IMF audit of the United States, and I had got the impression that the focus of that was largely on the so-called financial stability of the government of the United States and its macroeconomic practices on the scale of the budget deficit, the national debt, and things of that nature, rather than on the structure of the banking system, the effectiveness of regulation, whether or not underwriting standards were appropriate for in the case of subprime securitization and issues of that nature. Am I wrong about the focus of these financial so-called financial stability exercises?
There are really two very different exercises which are now conducted. The one which comes that every member of the IMF, all 185 of them, have these regular consultations with the fund on the macroeconomy, what the situation is, what the prospects are. That is called the Article 4 consultation and takes place more or less each year, certainly with the larger economies, including the US, and that's taken place for many years. In addition to that, in the wake of the Asia financial crisis, there was a quite elaborate process set up called the FSAP, the Financial Stability Assessment Program, which is a joint program with the World Bank and the IMF, but using a lot of expertise from supervisors and regulators throughout the world to engage in an assessment program for each member country that volunteered for it. It was not made mandatory in the first instance. It was very difficult to do that under the current rules of the IMF. But the idea was that people would volunteer. Many indeed did volunteer from a number of emerging market economies, some least developed, and a range of advanced economies, Canada, the UK, and so on, were early players in this. So there was an opportunity to bring together an overall assessment of whether or not the financial system was systemically stable. Now, that's very difficult, but you bring experts from particular aspects, from the banking community, obviously looking at the banks themselves, how that's done. You'd look at the payment system, the insurance system, if that were relevant, a whole series of questions. Now, the what if is, well, what would have happened had there been such a process in the US? The US did not volunteer for it. Would some of these questions about the need for closer look at how the supervisory structure works in the regulatory system in the US, would they have surfaced a little bit sooner than they are now surfacing? It's possible at least. At least it was a vehicle that could have been tried. The other aspect is that if, and this was a point made in an evaluation of the IMF and the World Bank program 2 or 3 years ago, in cases where there are major systemic players, in this case the United States and China, which at that point not had an FSAP conducted, what is the obligation of the institutions to raise that issue and say, look, there are important players in the system which have not had this assessment program done, and in a sense naming and, if not shaming, at least raising the issue of, well, shouldn't this be done? Isn't there a constituency of support for pursuing this line? So I'm saying that whether or not these processes would have resulted in a radically different system by now that would have prevented the crisis, that's a very big question. I would be very cautious in coming to that. But were the mechanisms in place that may well have asked some of the right questions? Yes, there were. Were they done? No, they weren't. And so the question in my mind is why that wasn't, and who is accountable for not having pursued those things.
I've got 2 more questions, and then I want to open it up to the audience for the remaining time. But the first one I'll address to Jan, which is we're seeing in this country the development of a plan to stabilize the banking system. And it is kind of an evolutionary development from the original Troubled Assets Relief Program that last September, but with very much, I think, the same general philosophy, which is to attempt to set a price other than the market price for the securities that are so-called distressed, and to provide. I mean, the TARP. The idea was to purchase them, but under the Geithner plan, the general approach is to provide a guarantee level, and therefore it is hoped to repair the liquidity of the banking system and to restart the markets in these securities. And I'm wondering whether you think that this approach to the banking crisis has any prospect of success, if success is defined as restoring lending and borrowing in the larger economy.
Okay, we have to, I think, divide the crisis into two pieces. Okay, we can go back to the beginning of 2007, when more or less the crisis was confined to one particular section of the financial market, one particular section of the mortgage market. And the policies that would have been appropriate then are clearly much different than the policies that are appropriate, shall we say, after summer of 2008 going forward. Because after summer of 2008, we were clearly in a question of a systemic crisis. And the difference here is that in the first period, it was a question of pricing assets. In the second period, it became a question of pricing institutions. And there's a big difference between the approach to those two. Now, the difficulty is that in the current plans, we still seem to be trying to price assets without realizing that the problem is pricing the institutions, that is deciding whether or not the institutions still have positive value. And if we watch what the market has been doing the last couple of days, the market appears now to be asking themselves that question as well, as we see what had been a slight recovery in financial institution stocks have now started to move in the other direction. So the market, I think, is now starting to force this particular question. And as long as we continue to believe that the bailout of the system is going to be in terms of providing prices or support for particular assets or particular asset classes, I don't think the thing is going to work. It's now a question of going in and doing evaluations of financial institutions. Now, it's very interesting that if you go back and you read the 1933 Emergency Banking Act, the beginning of the Emergency Banking Act has a very nice plan of how to do this. And it has always been a great puzzle to me why we could not simply have started there, because it worked reasonably efficiently in 1933, and it doesn't, there seem to be very
This is the bank holiday. And
that's right, that's right. Now, the one argument against this is that at that stage, banks were much smaller, and it was much easier in order to undertake that sort of operation. But by the same token, if you go back then, there were many more banks, and many more banks were in substantial difficulty. So it seems to me that argument sort of cuts both ways. That is, you can say, okay, sorry, the banks are now too big that we can't manage to do it. This is part of that argument which said that the banks were too big to regulate. And this suggests to me that, well, maybe it is time that we do go in, shut down these banks, and decide how large they should be. And part of that process of going in, looking at the bank's balance sheets, taking out what is in fact not sustainable, and which will then be categorized as losses to the holders without any necessity of doing any pricing, because it wasn't, when the RFC took over the bank and took over the bad assets, it wasn't as if they bought up the bad assets. They just simply took them onto the books at whatever they wanted to value them. In the end, if they managed to sell them at a profit, which they did, a large proportion of them, that's fine. But it was not a question of having to do any sort of pricing of individual assets to do it.
John, the last question for you is motivated by the morning's news. I see that the federal prosecutors in this country are asking for, I think, 52,000 names from UBS. And UBS yesterday basically opened the door for that by agreeing to turn over a certain number of names of people who in this country are suspected of using Swiss bank accounts for tax evasion, as a tax haven. And I'm wondering whether we are now seeing, for perhaps the first time, the possibility of a major break in the system of tax havens, fiscal paradises, which has so corrupted the world's capacity to tax those who are really the wealthiest people in the world, and whether the international monetary system is going to be aggressively pursuing the essentially closing up of this particular industry.
Yeah. I can't speak to whether or not that's what that's going to result in. I mean, all I can say is that where in following the last round of crises in Asia and Latin America and so on, there was, as Jan mentioned earlier, an attempt to bring the international community together to say, what are the areas where we should look at standards and codes of practice across a whole range of areas. And that had some success, at least in getting people to the table. It was a very complex set of players, a very complex set of issues. One of the issues set up there was to build up codes of transparency of fiscal policy and practice, which indeed has been conducted. So at least you bring the opportunity to be more transparent about the various systems that are done. Now, whether that speaks specifically to the tax haven issue, and I know the OECD has been doing a lot of work on that, I don't know. So I'm not sure whether we're in a different period now, if this is a new sign that you've seen. But what I'm trying to explain is when issues come up...
This is clearly a major development.
Yes, it is. Yeah, it is. It seems to be a lot of issues arising, which come up often in the times of crisis. These issues do come up. The question is how the system then adapts that and builds up the standards of practice as to how they should be conducted over a period of time. I would just like to mention just one thing at the end here, because I think it's sort of important for people who are thinking about these very often arcane and difficult issues. I would say from my own experience that in trying to second guess people who are in the middle of a crisis, government policy officials or so, is exceptionally difficult because the information available to them may be partial. They have to make extraordinarily difficult trade-offs in terms of difficult decisions. In the present circumstances, there's moral hazard if you go one way or the other. These are very, very difficult to second guess, even if you're very closely associated with the operations. They're even more difficult to do outside. So what is the role that can be played by an informed, interested, engaged community outside the policymakers in individual countries?
And particularly by universities, since that's the major theme of this
indeed, which is sort of the point of this conference. And I would highlight three, if I may. One is that there is clearly a lot of analysis of these evaluations of what went right, what went wrong. In our own case, for our own institution, we do reach out. Everything is published in terms of the issues notes for evaluation. The reports themselves are published. We do reach out and get academic support for some of the evaluative work that's done. So that's one specific input that can be provided. And I think other institutions would be well advised, even if they don't do that now, to do more of that. A second issue is a broader sense that if you're going to learn lessons from mistakes in the past, you have to evaluate it or assess what went wrong, what went right. You have to learn from that, and then you have to hold the people accountable for making the changes. This applies to all institutions if you're trying to strengthen them. The reason that things don't change very much or very quickly, and why in this financial crisis we see that not all the lessons have been learned very quickly the last few years, is that it's very difficult to initiate change anywhere. There are good reasons why individual people or institutions have incentives not to change. And one of the ways you manage to instigate change is to build a constituency to do so. And there has not been the sort of broad-based constituency for reform, for change, for activation, for holding people accountable that could be needed. And universities are obviously a key part of that. The whole education system is part of it. I was reminded from something Anne said at the beginning of this, sort of giving the sense of the history. The Bretton Woods institution set up after an appalling period, the 1930s, and James, you've written about this too. I mean, it's a very important factor in the setting up of these institutions after the Second World War, was to learn the lessons and try to prevent the terrible things that had happened not happen again. Because there was seen to be a collective action was worthwhile to overcome potentially beggar thy neighbour policies by individual countries. When I was brought up in England, we used to learn at school what these institutions were set up to do, what they were set up to avoid, the virtues of the IMF, the World Bank, the United Nations system, and so on. That's not to say you shouldn't be critical of them, but the basic purpose and role for them was very widely disseminated in the education system. I wonder, it's a question, I wonder whether there is a general building of that constituency now. The third point I would make in the role for universities is that increasingly these issues, which are so immensely complex, span different disciplines. You cannot deal with the financial crises as I was a few years ago in emerging markets, and now there's obviously these big issues in advanced economies, without detailed knowledge, not just of macroeconomics, which is one subject matter, but of legal issues, of accounting issues, of statistical issues, banking regulation issues, all have very different disciplines. You can't understand the motivation for people's behavior without looking at political economy issues, at the international relations and so on. Universities are in perfect position, including faculties and events like this, to bring together this multidisciplinary forum, because without that you will not get to grips with the problem of these crises.
Let me, with that, open it up to the audience for questions. We have, perhaps another 10 minutes or so to Kate Weaver.
I was very intrigued by what you all had to say about sort of the role of the U.S. in stymieing any effective response or mitigating the current financial crisis. And it relates to a question that's often on my mind about whether or not we can envision any kind of reform of the existing international financial architecture that can effectively deal with this basic conundrum of you can't live with the U.S., but you can't live without it either. And it's always that 9-ton elephant in the room when experts talk about things such as reform of the international governmental organizations, especially the IMF. That the power relations between the IMF and its largest member states is such that the IMF has very little leverage over countries like the United States to make them do anything that they don't want to do. And it's a serious problem insofar as those powerful states are now by and large responsible for the current kinds of crises we're seeing. So it's not like the IMF has to deal with Taiwan anymore, or Malaysia has to deal with the United States, and the U.S. isn't playing along. And of course, this is manifested in things such as the U.S. not doing Article 4 consultations, complying with FSEC regulations, and so forth. So that also means that the IMF is increasingly ineffective because it also has little power to start to look more carefully at the private sector, because it's an institution set up to work through governments. So the government has to be an intermediary, and if that government is not playing along, the U.S. is hardly doing that, then the IMF can't. It's very hard to do the end run. So I guess I have one of those impossible questions about how can institutions like the IMF or other existing institutions in the system do an end run around the hegemon in a way to become more effective? And if not, what does that mean for the future of these institutions? And secondly, I just completely unrelated question, but you talked a lot about the banking sector. I just saw in the Rubini Global Monitor that comes out every morning, Nero Rubini just wrote an article entitled, "Nationalize the Banks, We're All Swedes Now." And I was just wondering if you could react.
Nationalize the banks, we're all Swedes.
We're all Swedes
Please,
now.
I've got it. Yeah.
Go ahead. Jan, you want to take it? Can the IMF be made useful?
Okay. Just very quickly, in response to the first question, if you look at the way the Bretton Woods system was done, I mean, basically it was set up on a boat off the coast of Canada when President Roosevelt and Winston Churchill sat down and did the Atlantic Alliance. It was very much a two-power or two-state agreement, and the seeds of what came out were set up there. And it was the case of the ascendant power and the descendant power trying to work out something that was mutually compatible to both. And in fact, Britain ended up ceding virtually all of its requests to those of the United States. If we look at the current condition, if we were to have a similar thing, what would be the two countries that we would want to have? And I think clearly it would now be the United States and China. And the difficulty there is that it's unlikely, number one, that the U.S. as the declining power is going to cede anything in this sort of negotiation. And secondly, it's unlikely that China is going to try and impose anything on the system, because if I understand the Chinese policy, it's simply is that you stay in the shadow of the leader until you are big enough to take him out, so that you're not about to contrast anything before that time has come. And clearly, for the Chinese leadership, that time is still, I would say, probably 10 or 15 years away. So that what sort of result you would get out of those sorts of negotiations, I really have no idea. But that's where I think the difficulty is. On the second one, I'm sorry, I don't read Nouriel Roubini. And I'm not particularly certain that the idea of nationalizing the banks is the appropriate one. And again, nationalizing the banks means that effectively you have to get somebody to run the banks. And one of the difficulties that we have had with US government policy recently is that the US government has effectively privatized all of the functions which it normally carries out. And I'm very much afraid that nationalizing the banks would simply involve doing precisely the same thing. That is, we would nationalize the banks and then we would just give them back to exactly the same people who were running them before to run them. So I don't, I really don't see how that is going to solve the problem if the problem is the way the banks are in fact operated. That is, if it's in terms of the way the management decisions are taken.
Well, but if you, just follow up on that, if you've got a large bank which is deeply insolvent, and I mean, the FDIC has a procedure, a bridge bank facility, a pass-through receivership. You would not use that facility in these
No,
conditions?
that facility I would use.
How is that different from nationalization?
But I have no idea what he means by nationalization.
Okay, so I mean, that's my worry about the use of the word nationalization is that it places a political cast over a set of actions which are in fact part of the routine procedure involved in dealing with failed banks, and in fact was used by the Bush administration in the case of IndyMac in California. Jack, did you have a? Jack Sussman.
Thanks, James. It seemed from yesterday's conversations in the session on accounting, and generally from the way that governance has been thought to provide best responsiveness to local populations, that pushing decisions down to levels that are more local, more personal, more responsive with respect to the little guys in our world is, generally speaking, the most effective, whether we're talking about police enforcement, whether we're talking about accounting issues being decided at the firm level, how a particular country's firms will account for assets, liabilities, and capital, and so on. This seems to be a highly, strongly embedded set of values from a lot of people's perspectives. Is this emphasis on local enforcement? Now we have situations in which, again, in the accounting sphere, there seem to be risk management activities, risk management exercises that are taking place to shift assets, shift liabilities, shift risks to jurisdictions which will be more lenient or perhaps less precise in their demands for transparency, such that at the firm level, and including at the banking firm level, risk management becomes an exercise in gaming the system. And I'm wondering if, since we're talking about an era of taboos being broken here in globalizing economy, specifically the question of the U.S. actually nationalizing its largest banks, among others, the election of the current president being another taboo that was broken, let's face it, whether we have been too timid about seeing if there is a role for, not world government, but world governance along certain lines. And what I would ask the panelists would be, are there some technical issues, specifically relating to accounting and risks and dealing with jurisdictions, that we can build the kind of consensus, and perhaps at the university level that Dr. Hicklin was mentioning, around some of these technical issues within the political context in which we are operating. It seems as though accounting from yesterday's conversations seem to be a political exercise. And yet, can we in this era of revisiting some of these issues come to some kind of consensus as to what technically we can do, given the range of political regimes that are out there? What kinds of standards can we continue to push for? Can the IMF effectively work on the member country basis alongside the Financial Stability Forum on the broader level with private firms, push forward on the technical issues?
John?
Yeah, let me speak a little bit to that. I mean, one of the interesting aspects of this program that I described that was set up in the 2000s, the FSAP program, was that it has actually been extended, or there are parts of it, to jurisdictions, not just members, but some of these offshore financial centers. So there's quite a lot that's actually out, published now, about the assessments that have taken place of those. And that followed quite a long debate between the BIS, which was doing some work on them, and the IMF. So there is actually information out there. On the question of where the standards of on accounts are, and how the accounting standards are evolving. I'm sorry I missed the panel yesterday on that. But there actually is a quite rich discussion, which I'm now not privy to the latest part of it in my current job. But I mean, there's quite a large body of work that's going on in terms of accounting standards and how those fit into the international standards, which are then to be assessed, which I think is worthy of study. And so, I mean, I would commend that. Finally, on the private sector, you asked about the private sector. I would say the big change in the fund over the last 15 years has been the greater transparency. Now, we could obviously say it needs to go further and so on, and I think we've made those arguments ourselves at the IO. But nonetheless, there has been a much greater dissemination of analysis and information, which does help the private sector see in their own decision-making what the views are. And I think there has been greater meetings with private sector participants, there have been fora and so on. But the former, when you ask the question of, well, who is accountable to what for whom, it's very clear that the executive authorities within each government are the ones that would have to be accountable for whether or not they were interacting properly with their private sectors. So you have this mixture of greater transparency, which should improve decision-making, one hopes, globally. But on the other hand, not mixing that with the accountability for who's responsible for making sure that systems work, both nationally and internationally.
Jan, final word?
If you think of the problem of global governance, it just sort of emerges naturally by the fact that the economic system is more global and more globalized. So it's a very simple sort of response. I sort of like to look at this in the following way. We have discussions and disputes over whether central banks should be independent or whether they should be democratically accountable. One of the basic things that the global system lacks is a global lender of last resort. The response to this is a global central bank. How in the world do we resolve the problem of the democratic accountability of the global central bank? I don't have an answer.
Well, on that note, we perhaps set the stage for the inclusion of discussions of these matters in future conferences. And I want to thank both panelists for a fascinating hour and a very responsive reaction to the questions that I've been posing. Thank you both. Thank you all.
Thank you.